Hi guys, I'm AP. In this video, we are going to see the chapter 14 in the book The Intelligent Investor. The chapter 14 is stock selection for the defensive investor. In this chapter, we are going to see how the defensive investor should select his stock for his portfolio. Okay, in the previous chapter itself, Graham gave a clear difference between the defensive investor and an aggressive investor. The defensive investor is who spends less time in the market to analyze and pick his stocks, and an aggressive investor is who spends a lot of time and energy to allocate his stocks and his portfolio. Okay. Graham clearly says that this book is not about how to interpret and analyze the annual report or a financial statement. Rather, this book is for to set a mindset for an investor, so that the points I may going to say is seems repeated for you, but this is what Graham mentioned in his book. Okay. Now let's see the chapter 14. Graham says we are going to analyze a company by his past performance, but there is always a standard in which we can analyze a past performance. Graham says two ways. First one is quality and second one is quantity. The first one is a minimum of quality in the past performance and the current financial positions of the company. It's nothing but in the past performance the company should perform well, and in the presence also the financial positions is nothing but the debt and working capital. It should be in a positive way for the company. And second one is the quantitative one, minimum of quantity in terms of earnings and the asset per dollar. It's nothing but the company should show at least in positive earnings and a positive in an asset class. Okay. Now Graham says there are six ways one can analyze a company. The six ways are, it may seem repeated for you, but Graham says six things repeatedly. The six things are, first one, adequate size of the company, and second one is financial conditions, and third one is earning stability, and fourth one is dividend record, and fifth one is earnings growth, and sixth one is P by E ratio, and seventh one is moderate P by asset ratio. It's nothing but P by B ratio. Okay, now let us see that in an elaborate way. The first one, adequate size. Adequate size, Graham mentioned, is a large cap company. The company which over almost $2 billion in the market cap. Graham says we should always choose that type of company. Okay. The second one is a strong financial conditions. A strong financial condition Graham mentioned is about the debt and the working capital. Debt, a company can have a debt but less than the half of its asset. Let's make plan. If the company has a asset of 100 crores, then the company can handle a debt of 50 crores, so that in the long term it does not affect them. Even in some bad financial years, the debt they are going to repay may not be a burden for them. So that we should always consider a company with the strong financials. Third one is earning stability. I have mentioned about this in earlier chapter. Earnings for 1 year and 2 year, it's not a matter. The company should show a earning stability for almost past 10 years, so that the company can survive every bear market and bull market and then varying economic conditions. The company can be a good one to invest. Okay. The fourth one is dividend record. Raya mentioned an uninterrupted payment of dividend at least for 20 past years. We can take in this way also. The company should at least be 20 years in the stock market. It's also a factor that we can consider before investing. When one company can provide dividend to their shareholders, when the company make profit, in that profit they can share some amount to their shareholders. I am indirectly mentioning that the company should make a positive profit so that we can invest in that. Okay. The fifth one is earnings growth. In the previous one, Graham mentioned earnings stability, and he also insists the company should show a steady in earnings growth at least of 7% year on year, so that an investor can invest in that stock over a period of time to get a very good return. And sixth one is Graham's favorite one, seeing the P by E ratio. P by E ratio is nothing but price to earnings ratio. Graham says earlierly that how much attractive the business is does not matter. This matter is what at what price we are buying that business. This is a very important thing. Even though the company may seem very good in profit and a monopoly company in their industry, that does not matter. What matters is at what price we are buying. It's an important thing according to Graham. We should always buy at least bandwidth of their intrinsic value, so that in the long run we can make a profit out of it. Seventh one Graham mentioned is the P by B ratio. We didn't discuss in the earlier chapters. Now let us discuss. The B stands for book value. Book value is nothing but asset minus liability. Let us consider if a company has a asset of 100 crores and liability of 50 crores. If we minus that, then the net book value will be 50 crores. It is what Graham says. The book value should be a positive one. And if we compare our price to book value, then it is not more than 1.5 times. If we are Considering that Graham mentioned 1.5 P by B ratio in the stocks, then we may tend to have only very few choices. But when market behaving silly, that is nothing but a bigger market or a high volatile market, we may tend to have a very good stocks coming under this category, so that we can happily invest in that. Even in this chapter, Graham mentioned of buying index funds. Graham mentioned one should always consider at least some 20% of the money in the rental capital to invest in their index fund, so that in the long run, even though the invested money in the stocks fails, but it will be helpful for them in the long run. Okay, this chapter I will say large, prominent, and conservative in finance, the company we should invest, and we should make sure that we are not giving more price, we are not overpaying the valuations, so that in the long run we can make a profit out of it. The P by E ratio Graham says is not more than 15 times. We should always cautious in that. Okay. In the next chapter, we are going to see the stock selection for an aggressive investor. Stay tuned. Thank you.